everybody. Thank you so much for joining. So Cameron covered interest rate derivatives. We had Adam discuss developments in the commodity space, and now we're going to shift gears to foreign exchange. So many of our clients face foreign exchange risk. It could be a situation where a client is importing a piece of equipment from overseas. They might be invoiced in a local currency, as an example, in euros. At the time when they take a look at that US dollar equivalent, as an example, euro might be trading at 110. If that equipment costs 1 million euros, client might be assuming that they're going to pay 1,100,000 for that equipment purchase. Now, 6 months down the road, when they have to make a payment for that equipment, the exchange rate might look quite different. So if euro strengthens and the exchange rate moves to $1.25, this equipment is now not costing 1,100,000. It's costing 1,250,000. So this is what we would consider transaction exposure. Other clients might be facing translation exposure. So if you are a foreign-owned company which has loans from the parent company and you have to revalue that loan into US dollars, again, as the currency rate fluctuates, the US dollar equivalent is going to look different. If you have an operation in UK, as an example, operation is valued at 1 million pounds. If pound is trading at $1.40, that US dollar value is going to show that it's worth 1,400,000. If pound sterling drops to $1.14 as it did last year, that valuation in US funds is going to be significantly lower. So that's translation exposure. Now, other clients might not be involved in cross-border transactions, but they might have competitors who are located outside of the United States. So if this competitor is located in China and Chinese yuan depreciates in value or weakens, their products become a lot more attractive to companies here in the US because they're simply cheaper. So our clients might lose market share as a result of the foreign competitor simply having that foreign exchange rate advantage. So many clients, when we ask about foreign exchange risk, whether they have it or not, they answer that, well, we do import products from overseas, but we pay in US dollars, so we do not have foreign exchange risk. I think this is the biggest misconception out there, and this is why. So when foreign suppliers invoice our clients in US dollars, a lot of times they include a cushion, which basically makes it more expensive for our clients. So if US dollar weakens, as an example, your price is going to go up. If the US dollar strengthens and that supplier is getting more of their local currency units per $1 US dollar, they will not adjust the pricing lower unless, of course, our client brings it up. So again, a lot of times there's a cushion included because when you're sending US dollars overseas, that payment still needs to be converted to the local currency of the supplier. So currency conversion is happening. It's happening on the other side, and somebody else has to manage that risk. And since the supplier has to manage that risk himself or herself, our client ends up paying more for it. So a lot of times by accepting US dollar pricing, you might be leaving money on the table. So as an example, this is a client who is actually located here in Northwest Ohio, who purchased some equipment from Canada. They were planning on sending a US dollar payment. This is obviously what they felt more comfortable with. However, this transaction got flagged to the foreign exchange desk. So what we did was we reached out to the client to determine whether they had an option to pay in Canadian dollars. That invoice, which they received from the Canadian supplier, actually included both the Canadian dollar pricing and the US dollar pricing. So at the time when we were making this payment, we took a look at the exchange rate. At that time, Canadian dollar traded at $1.2901, meaning $1 US dollar equals $1.2901 Canadian. So if you take a look at that Canadian quote, of 1.3 million Canadian. At the rate of $29.01, the US dollar equivalent is 1,019,000. That supplier said that you can pay in Canadian 1.3 million or US dollars 1,078,000. So if you compare 1,019,000 against 1,078,000, you can see that by paying in Canadian dollars, you are saving $58,000. So this client actually ended up obviously sending Canadian dollars instead of US dollars and saved over $58,000. So what are the best practices when importing product? Always, if possible, obtain a dual quote, right? The quote in the local currency of the supplier and US dollars. Talk to your foreign exchange desk. If you do not have one, I would suggest contacting a bank which has the foreign exchange capability. So what the foreign exchange desk would do is basically take a look at that foreign currency quote, take a look at your payment terms, and based on the payment terms and when you need to send these payments, we can determine what the forward rates are and whether it's more cost effective to send the payment in the local currency of the supplier. Keep in mind that if you do need to set up with a foreign exchange desk for hedging, there is documentation required and there is a credit approval process that you have to go through. So bottom line, in most cases, paying in the local currency of a supplier is more cost effective because you're eliminating that cushion. You are also avoiding wire fees because when you're sending wires in US dollars, you pay wire fees. If you send payments in foreign currencies, there is no wire fee. Plus, you have more flexibility when it comes to delivery of funds to the beneficiary. Now, when you evaluate whether you have your foreign exchange risk, what should you think about? So if you have cross-border transactions, you are definitely exposed to foreign exchange risk. If you have manufacturing locations outside of the United States, if you have employees outside of the United States, if you have a foreign parent, if you have foreign loans, if perhaps you might be talking to a potential client who is outside of the United States who wants to get invoiced in their local currency. If you decide to quote them in euros, pounds, whatever the currency might be, you will have foreign exchange risk. So if you take a look at your statements and there is noise there, if you see translation gains or losses, obviously you have foreign exchange risk. So now we're going to talk about what happened during the pandemic and focus on some of the major currency pairs. So a lot of factors which influence the foreign exchange market, one of them is central bank monetary policy. So what this means is if the central bank decides to increase interest rates, this is supportive for the local currency. If you take a look at geopolitical news, election of a trade hawk president, which we witnessed in 2016, caused weakness in Mexican pesos and Chinese yuan and a number of other currencies. Economic news impacts the currency market as well. So tomorrow, everybody's going to be watching the release on non-farm payroll. So the market watches very closely employment information. It watches, especially here in the U.S., inflation. If the economy is strong, the currency is going to reflect the economic fundamentals. We have technical analysis, so support and resistance levels, of course, expectations and rumors. So in some cases, there are currencies that are impacted by commodity prices. So as oil prices go higher, you might see Mexican peso or Canadian dollar get stronger as a result. So real quick, this illustrates what the currency market did last year at the onset of the pandemic. So you can see euro initially strengthening. This is when European investors were liquidating investments overseas, buying euros, which created additional support for the euro. Then the euro dropped. If you take a look at pound sterling, again, significant fluctuation there as well. Pound was trading above 130, flying to 114 and change within days. Again, we were looking at flight to safety, risk aversion. The dollar always works as or acts as a safe haven. So at times like this, the dollar appreciates. So you can see that happening against the euro, against the pound sterling, which at this point hit a low that we did not see since 1980s. Mexican peso was trading below 19. All of a sudden, when pandemic happens, peso weakens to 25 pesos to a dollar. Canadian dollar, this is basically covering period of time between 2010 and 2020. You can see what the Canadian dollar has done during that period of time. And this specific slide focuses on exactly what happened last year. Again, the same situation. Canadian dollar drastically weakens, goes from $1.30 to $1.45 level. Again, at the onset of the pandemic, last year, mid-year, the dollar started to weaken. So again, another example of a currency, in this case, Chinese yuan. You can see what the currency performance was at the time when tariffs were announced as well. So this basically shows you that the currency rates fluctuate. They fluctuate throughout the day quite a bit, and especially during times like the pandemic, financial crisis, or even in between, the currency rates will fluctuate, and a lot of times quite drastically. So why do we hedge foreign exchange risk? Well, obviously, the market rates can fluctuate. And by locking in an exchange rate and hedging that risk, you're able to lock in your profit margin, right? You can meet your earnings and profitability expectations. You can focus on your primary business. You can develop growth and sales strategy since you know what your costs are. So there are a number of solutions that many clients in the middle market space utilize. And one of them is a forward contract. It allows you to lock in an exchange rate for a future purchase of the currency. No matter what happens in the future, you're locked into that specific exchange rate. You're locking in a purchase or a sale of a specific currency and specific notional amount for a specific date. Now, if you're looking for more flexibility, you might be buying equipment, but you can't pinpoint the exact date when you might need to pay the euros. You can lock in an exchange rate for a window of time as well. So you are locking in an exchange rate for a window of time. And again, no matter what the market rates look like down the road or during the time when you take delivery of the currency, that rate that you locked into is the rate that you receive. Some clients, and we see most of it happening at the large corporate space, some clients decide to go at an option, which basically, in a way, is an insurance policy. It allows you to buy protection, but if you choose not to deal, you don't have that obligation. So it gives you the right, but not an obligation to buy or sell the currency. So there are some scenarios that we have already gone through. U.S. companies sourcing equipment from Canada in U.S. dollars. If you recall, we basically covered the scenario where paying in the U.S. dollars is not as beneficial as paying in the local currency. In this case, it was in Canadian. Purchase of equipment from Europe. Also, another example, a U.S. company decides to sell product in Canada and Canadian dollars. So we had a situation with a client which decided to discontinue partnership with a distributor and decided to start selling their product in Canada on their own, but did not hedge their risk. As the currency rate fluctuated, they realized that they were not hedged and the U.S. dollar receivable was much, much lower. So again, another example of why it's so important to hedge foreign exchange risk. U.S. company with real estate investment and basically deciding to pay off a U.S. investor prior to selling the real estate in the Netherlands. So this client decided to actually go at an option trade with a way to hedge, but a solution that gave them the right but not an obligation. So they purchased an option to sell euros at a specific strike level. and didn't have to worry about that rate potentially dropping. We have quite a few clients in the automotive space. They might have operations in Mexico. One actually is non-auto related in healthcare space, which has operations in Mexico. So these folks hedge their expenditures in Mexico and in China. They might have payroll expenses. So they lock in the exchange rate for yuan. They lock in an exchange rate for Mexican pesos. One thing to also keep in mind, if you have both payables and receivables in the same currency, you might want to open a currency account. If it's receivables and payables in Canadian funds, it would make sense to open up a Canadian dollar account so that you can create a natural hedge. So again, there are a number of different scenarios we can go through. I think I'm running out of time here. So if you have any questions, if you have any concerns, please don't hesitate to reach out to us if you do not have a foreign exchange risk. And I look forward to hearing